for your time.
Of course.
There we go.
Okay. All right, awesome. So I think everyone can see this. Cool to be here today. If you're not familiar with who I am, I'm Matt O'Connor is my doxed name. Matty Tokenomics is who most people originally know me as, founder of Legion, but today wanted to try to take an objective stance. Obviously, as the founder of a platform like Legion can't be purely objective, which is important for you as founders to keep in mind. But trying to take an objective stance here, thinking about from your lens, from a founder's lens, thinking about your launch, looking at Launchpads, looking at fundraising options, and so looking at platforms like Legion, like several other players from that lens. And there's a couple different benefits or reasons different teams look at it. Some are purely looking at it from a fundraising point of view. Some are purely looking at these things from a go-to-market, from a TGE point of view. And so exploring kind of both of those angles and others, and coming away with some practical advice, practical watch out fors as you navigate this process. That's my goal for this talk. So have a slide deck here. We'll go through that. Of course, if there's any questions that come up along the way, feel free to raise a hand, hop in. Happy to make this more collaborative, and then of course at the end also hang around for some questions. So to really dive in here, right, and think about what it is we're talking about, what it is that matters so much when we're thinking about launching a token, raising capital, using a launchpad, if you want to call it that, right? The decision that you're making isn't just like which launchpad to pick. It's how you want to trade capital for distribution, right? Because you're going to pay, regardless of what option you use, you're going to pay for it in some way. And so whether you're paying cash, whether you're paying tokens, whether you're paying performance benefits, whatever that is, you are getting some benefit from launching, and you're going to make some payment for doing that. And so it's how you're trading your capital for distribution and what instrument your buyers actually want in that distribution. We'll get to that in a moment, but it's increasingly becoming relevant for founders to consider: am I launching a pure kind of governance token? Am I doing equity? Am I doing something that's a mix? Am I doing tokenized equity even, right? It's not quite as simple as it was a cycle ago of just saying, oh yeah, we're launching a token, beautiful, no questions asked. There's nothing more to it than that. So to first set the context, right? Think about the market you're launching into, and this is kind of like the bull case lens. Is there has been a tremendous amount of fundraising activity, capital activity over the past year. So projects in 2025 raised like over $20 billion. That's up from 2024, which itself was up from 2023. Crypto IPOs, so Circle, right, IPO'd, I think, blanking on the name here, the custodian, but they also IPO. There's several big IPO. BitGo IPO'd several big IPOs last year, and you've got a bunch of tokens coming onto the market, which is in one case a bull case because there's so much activity, and then, as we'll see in a second, also a bear case though. But there's about $155 billion of tokens scheduled to unlock over the next few years, over the next cycle and change. And getting to this bear case, it does need about $80 billion of new demand just to hold prices flat, according to Binance research. So that brings us to the bear case for the market you're launching into, which is just as important, if not more important, to keep in mind. And it's that probably wouldn't or should not surprise you guys, but we're launching into a market where down only is kind of the standard. It's kind of the expectation, right? 29 out of 30 tokens listed in Binance were in the red. Greater than 80% of Binance listed tokens were down from listing in the prior 6 months. 44 net down 44% to down 90% was the range on Binance Labs backed cohorts. So if this feels like I'm beating up on Binance, it shouldn't. It's a compliment to Binance that they're the the place to launch still. They're the metric by which the whole industry and a launch is measured. But this really drives home the point that even on Binance, the #1 exchange to launch on, pretty much everything is in the red, right? And so you've got these low float, high FDV launches that go down that are still the market standard. The average market cap to FDV ratio is still around this like 12%, right? So low float to high FDV, that's even higher than you'll see from a lot of teams these days, right? So market cap to FDV is basically a percentage of tokens circulating, low float. So with that in mind, right, with that context of like we just had a cycle of tremendous activity from VC funding, we're now headed into a cycle of we need a shit ton of demand to sustain prices. Tokens are going down. There's rumors of VCs capital drying up. That's kind of the market we're headed into, and you have to think about the 4 different vehicles available to you and the trade-offs. There is no perfect answer. There is no one approach that works for every single situation. There are only different approaches that work for your different cases. And so largely speaking, the 4 options available to you are going to be a SEX Launchpad, right? A Launchpad directly operated by an exchange. A decentralized Launchpad, these oftentimes, but not necessarily, are more permissionless, right? So like anyone can do this. It could be like a liquidity bootstrap mechanism, for instance. A more curated or underwritten sale that would be more like Legion, like effectively a permissioned sale. Legion, CoinList, right? These type of players that are not just letting anyone launch like a decentralized Launchpad is. And then, of course, you could just forego any kind of sale as your distribution mechanism and only do an airdrop. And largely speaking, you can think of these things across a number of different dimensions. But the key ones that founders are thinking about is how much capital can they raise, right? How much distribution does this give them? How much control do you have over things like the TGE price? What is your regulatory risk? This is arguably, depending on where you are in the world, where your team is based, the most important thing to think about first and foremost. And then, the filtering of who are the buyers that are actually getting my token? How can I make sure they're good people, they're humans, they're not bots, they're not Sybils, they're not mercenaries? So those are some of the key dimensions on which founders are usually basing their decisions when they look at these aspects. And so on a centralized exchange, you can raise a ton of money, like 5 to 50 million is not out of the expectations, depending on what that project is and what the exchange is. Depending also on the exchange, you're probably going to get the highest penetration of retail, users. Obviously, it doesn't always mean, like a tier 4 exchange compared to a tier 1 curated marketplace is not going to get you more users. But all else equal, for comparing tier 1s across the board, a tier 1 exchange is going to get you a lot of distribution reach. Your price discovery, you're going to have relatively less control because the exchange has all the leverage in this conversation. So the exchange is going to want to, control that very tightly. They're going to want to give their users a very, very attractive sale price. And so they're probably going to push you into something like, doing a sale. Let's just normalize all the data, right? So it's easy. Doing a sale at like a 50 million FDV and then a TGE at 100 million FDV, right? Just so that like their users get this immediate discount, this immediate good price to buy into. And that's going to be bundled and packaged with, okay, well, if you want to get listed on the exchange, right, here's what you need to do. Here's the terms of the sale. And so, yes, you can negotiate, but they're going to have most of the leverage in that conversation. And so, relatively speaking, they're not going to go for price discovery. It's going to be driven by the exchange. The regulatory posture depends on the exchange you're launching with. It's not always necessarily weak. There are some exchanges that do compliant offerings, MiCA compliant offerings, for instance. An Asia exchange is not going to care about any of that stuff. So again, it really, really depends on your specific risks, your specific team, where you're located. If you're in Europe, and you're not following MiCA, you're running a much higher risk than a team that is in Asia and is not doing so. And then filter quality, it's largely going to be up to the exchange, right? They're going to have their criteria that determines who can buy in. It's going to be their points holders or their loyal customers or their KYC users. You're not going to have too much say. On a decentralized launchpad, you're generally raising a lot less money. The distribution reach can be, medium. The relative benefit is that you're typically not requiring people to do KYC, right? You can go more global, go more on chain. The relative downside is you're missing out, I should say, on more, crypto curious type of users, people who only do, stay like away from DeFi, stay in the more like, custodial type of crypto solutions. But you have a lot more, options for price discovery. You have a lot more risk when it comes to regulatory posture. Generally, most of these cases, they're not following all the regulations, let alone KYC. And your filter quality is a challenge, to be honest, right? You can get a lot of Sybils. There's not much you can do to resist Sybils. There's some clever mechanisms to resist sniping, right? Where like bots just get 100% of the allocation, but that remains a risk, and Sybils remain a major risk. On the curated side of things, again, platforms like Legion, platforms like Echo, platforms like CoinList, what you can raise varies pretty largely. You generally need to raise, would generally have a higher minimum raise than a decentralized launchpad because there's more that goes into this. It's more, high signal, but you can raise a very, very large amount at the same time. I mean, when we did, just as a example, when we did yield basis sale, they had $200 million deposited in the smart contract in less than 24 hours on Legion alone. So yeah, you can, if it's a big project, if you've got all the right people involved, you can raise a large amount of money. It's not necessarily putting you at a disadvantage versus a centralized exchange. Distribution is similar, medium, high, right? On a sale, like a high profile sale on Legion, you're going to get greater distribution than a tier 2 kind of, centralized exchange. Price discovery, this is a bit misleading. I wouldn't necessarily say merit-based relates to price discovery, but you do have options here, right? To negotiate price. We have auction mechanisms, various different, launchpads will have similar approaches where you can set that price discovery. We also at Legion like to do things like making an interactive process. And so it's not just like, hey, founder, guess what your valuation should be. We're going out, we're crunching comps, we're looking at realistic, valuations. We're looking at our power users and bouncing it off of them and saying, how much would you bid for this? So you have a data-driven kind of estimation of where price could start at and appreciate from. Our regulatory posture, at least for Legion, most of the curated platforms tend to take regulation more seriously than the decentralized ones. Yeah, so we take great emphasis with MiCA, with US regulations. We'll get into that in a second, the changing landscape there. In some cases, you can actually include US persons. And then in terms of filter quality, approaches differ wildly again, but you're generally speaking going to have more control over who you let into the sale than either an exchange, because they're going to dictate it, or a decentralized option. And in Legion's case, we have all these rich analytics on like, here's this person's social stats, here's this person's on-chain stats, here's this person's developer stats, here's this person's previous Legion usage stats, their holding activity, did they dump immediately? All this data, all these analytics that you can use in terms of selecting who to give more allocation to, who to give discounts to, who to whitelist, et cetera. And different players are going to have different approaches to that, but largely speaking, you'll have higher filter quality ability. And then finally, I mean, airdrops, not an alternative if your goal is to raise funds, but an alternative if your goal is to distribute your token. Obviously, you're not going to raise any funds, but I would say it's probably true that you have the highest distribution in terms of attention, all else equal, because it's free. And so like the number of people or the number of wallets that show up is probably highest, which does not correspond to the number of human beings that show up or the quality of those people that show up. Price discovery, obviously none. You're airdropping and then you're TGing. So it's, there's no price discovery for the sale itself. It's just your TGE price. Regulatory posture, it's going to be like, realistically, it's going to be safe. Like, yes, actually, technically speaking, even airdrops should do things like a MiCA white paper. So you can be kind of running some risks there. From a practical point of view, you're relatively less risk. So there's things you can do to button it up, but Yeah, it is somewhat of a gray area, but relatively less risk. And then filter quality, man, it is hard to filter out Sybils and airdrop farmers, right? Doing it after the fact. Yeah, I think you have one of the weakest abilities here, assuming you're not KYCing, assuming you're doing things, after the fact on your points program. There are things you can do intelligently to design a better points program. You can look at examples like Drift. Drift is down recently because of the hack, but they actually did a TGE very intelligently. Lighter also did a great job with their points program. Bit of a separate conversation, not really relevant to this topic we're talking about today, but there are things you can do to improve that if that is an alternative you're looking at. But I think for most teams, getting in buyers, getting some capital in, and getting the natural filtering that happens by people just putting dollars where their mouth is, right, rather than just showing up and getting something for free, that alone has a filtering effect. And so I think most teams are looking increasingly at some kind of capital formation that is tied to their token distribution. Now, to be blunt with you, I think there's a major problem here of that most valuations are just too damn high. And there's some competitors here that agree with me, some investors here that agree with me, or borrowing, paraphrasing their terminology here. It should be no secret to you as a founder that most token launches in the market here are basically uninvestable, right? You just got tokens that launch, massive amounts of inflation that come on, super high valuations, propped up because it's low float, high FDV. So the team has raised, hundreds of millions in VC capital. They give some of that to a market maker. They launch at a market cap that's, a tiny fraction of FDV. And then because that market cap is so low, because the supply on the market is so low relative to the capital they've raised, they can literally just prop up that token price, inflating the FDV without, with only a shred of the actual true total FDV defending it. Teams, this is Hasib. Teams try to get more tokens out on day one. Sub 10% token supply is still too low. Consider pricing tokens on day one using an open auction rather than the function of last VC round. This is a proposed, basically, solution to this. I do think this makes sense for some teams. You have to be really careful about what your objective is, what your goals are, right? Which varies from team to team. But generally speaking, the market is getting sick and tired of teams that are launching at a fixed price, way too high FDV. The FDV goes down. Everyone knows that the TGE day is the expected all-time high of the token price. So they're dumping. It becomes a self-fulfilling prophecy. And then people are moving on from your project to the next thing, and they'll never think about you again. So as much as it kind of sucks as a founder to launch at a lower valuation or launch at a valuation that you're not really certain about because it's up to the market, like an auction, or launch with a higher percent out there, it's increasingly becoming not just suggested, but really a necessity to be competitive if you want. If you care about anything at all other than just max extracting on day one and never showing up again, then you really, really have to take seriously as a founder things like value accrual, things like equity, as well as your token, things like your token converting into equity, tokenized equity, the valuation you're launching at, all these things. We'll talk about them a bit more, but it's becoming more and more relevant, not less relevant, right? If you wanted to get super uber rich by ripping people off and then just sailing into the sunset, you're about a cycle too late to do that. And this is a healthy thing overall for the market, that this is going away slowly but surely. A quick note on retail versus VC as we continue this theme of VCs. One of the biggest reasons that the last cycle saw so much VC activity was because VCs were just buying in and playing this kind of token launch arbitrage, right? Whether there was a massive valuation premium to tokens, and then they also get their tokens liquid years before, decade even before equity would ever become liquid. And so there was a whole class of tier 2 plus VCs that basically were just no-name people who got a bunch of money together and just invested in anything and everything that would launch a token soon, and that they could sell the tokens in the secondaries market. Because one of the dirty secrets of this industry is that even when you have investors that are locked up on paper or locked up on chain, right, they can oftentimes arrange a secondary trade where they're selling those locked tokens at some discount to the market price. And so that is one of the reasons why VCs, as I mean, maybe this strikes you as paradoxical, maybe not, are usually less sensitive to vesting terms, specifically unlock terms, than retail. So retail is usually more sensitive to unlock terms. And so for a Launchpad sale, that's really, really relevant for you, right? Because you're thinking about all these things of, okay, I don't want my token to dump immediately, but I need to attract buyers. So how do I find that sweet spot, that optimized spot of terms where there's some percent unlock at TGE, but my total float out there is not too crazy. So there's a lot to balance in this current marketplace, because you really can't go, most projects at least can't afford to go 100% on unlock at day one unless they're launching at an extremely low valuation. But at the same time, there's just no appetite and no tolerance, no patience anymore for low float, high FDV, right? So you really got to find the optimal trade-off given your specifics, how much money you have in the bank, the market maker terms you're working with, et cetera, to really find that optimal place of FDV and unlock schedule. And yeah, retail is more sensitive to unlocks than VCs are. And so if you go and you try to do a retail sale these days, even at a low FDV with like a 1-year cliff and like a 3-year vest, terms which would be standard for VCs, you are going to get very, very little retail interest. Again, all else equal, compared to having some unlock, and much less interest for retail than you would compared to VC. So I want to now shift gears a bit away from like the overall market and these trends and get more specific into what a Launchpad actually gets you and what it doesn't, right? So these are the benefits that you're going to get, so that you can think about the trade-offs you're making and the costs you're willing to pay. Curated sales can be, this formatting messed up here a bit, sorry, but curated sales can be wildly oversubscribed, as we've talked about, right? And that oversubscription alone can actually be one of the strongest benefits of the sale. So like yield basis that we ran was about 100x oversubscribed, Umbra 200, Falcon X 30x, right? All these sales being massively oversubscribed. Anytime you're getting like 10x, ideally 20x and greater oversubscribed, that alone becomes a signal to the market, right? Of like, holy crap, a bunch of people want to buy this token. There's a bunch of attention about it. Even if, not all of those people are getting filled, which does have some downside. We'll talk about that in a second. It brings in a lot of eyeballs. It brings in a lot of capital. And so for instance, for yield basis, they had like $200 million deposit, as I mentioned, locked in a contract in less than 24 hours. And not only does that draw in retail buyers, that becomes one of your strongest, if not the strongest, negotiating points for leverage with all the other conversations you're having around TGE, right? It's this golden window of negotiation with centralized exchanges, with market makers, right? With other parties, where you can use this leverage. Look, we are the belle of the ball right now. We are the ones getting hundreds of millions of dollars deposited. We're the ones that are wildly oversubscribed. Everyone's trying to buy our token. Hey, you want us on your exchange. You want to market make us because we're going to have tons of trading volume, right? You want to be the KOLs associated with us. And so this is your golden opportunity to run a sale, get oversubscribed, and then use that to get cheaper or higher quality listings. In yield basis case, there's actually at least one tier 1 exchange that reduced their fees considerably to let them on after this oversubscription happened. And another case where a tier 1 exchange had rejected them before the sale and then literally about faced and accepted them for a day 1 listing after the sale. So this can be, let alone the capital, the oversubscription element can actually be one of the biggest benefits of doing a sale. And so when you tightly curate your sale, when you're launching on a Launchpad that is high signal, that is known for kind of these high notable sales, you get benefits of like a lot of these projects launch immediately up on TGE, right? From 5 to 10x up, tend to perform better, all else equal, dragging out even as emissions happen, and still tend to stay positive longer, especially when you control for the relative to the market. So all the elements that we've talked about of like too much supply coming online, people being sick and tired of low float, high FDV, dumping tokens. Don't get me wrong; those all still very, very much apply. But the more signal you can get by launching on a high quality Launchpad, by getting high quality exchange listings, by having massive oversubscription, it helps abate that to some extent. The problems that Launchpad really solve, right? You've got to think about some of these things as we've already talked about. Sniping at the open. So there's been some, brutal cases of sales in the past where like bots, within like a fraction of a second, the sales sold out. It's like very, very clearly, whether the Launchpad admits it or not, is bots buying all that activity, right? The bots are buying all the supply. So sniping is a problem. Sybil resistance is a problem, which is related to sniping. But even if you have the sale spread out over amount of time, those could still be Sybils, low float, mercenaries, dumping, right? And so you got to think about how you protect yourself against all of that. I mean, yes, okay, you could say this is a bit biased, but roughly speaking, breaking down each of these three different approaches, airdrops are not relevant. For a centralized exchange, they're going to largely have sniping solved, not necessarily all the case, so it's important to chat with them about their mechanism, but generally it's going to be off-chain clearing, right, on their own books. It's not going to be done on-chain. So worst case scenario, they can go back and rerun the sale. They can wipe out trades, right? Generally speaking, it's solved. Sybil resistance is partially solved. I think that all the exchanges we have worked with have been shocked at how easy it is to buy KYC, fake KYC on the black market. And there's literally Telegram groups you can go into and just instantly buy KYC'd accounts to any of these, major exchanges. And so, yes, KYC provides some Sybil resistance. It doesn't really provide full Sybil resistance. Sexes are going to push you towards their favorable terms. And, especially because the sexes are pushing you to do a launch at like, do your sale at a 50% discount, all those people are going to dump the token, right? And this is also something you should keep in mind when negotiating with exchanges. Some exchanges might say, oh yeah, don't worry, our fee is, 5% of your token supply, but half of that vests over 90 days, and we don't, it's lies, right? Like, unless you are literally holding the tokens and delivering the tokens to them over time, you should treat every token you've given to an exchange as it being immediately sold, even if your contract with that exchange is explicitly forbids that. They do not give an F, right? They will dump your token immediately. They will blatantly violate the agreement they've signed with you. And that's just unfortunately what you have to budget in for. A decentralized exchange oftentimes is going to be weakest at sniping. Yes, it somewhat depends on the mechanism, but this is where you get into risky, you have to just investigate this more thoroughly, more carefully as a founder. Same for Sybil resistance and same for mercenary dumping, largely because of the weakness of Sybil and sniping. Curated marketplaces, relatively speaking, offer benefits here where we have much more control over when, who, how people are bidding, right, or submitting requests for allocation, right? So in Legion's case, for instance, people can apply for allocation, and then you as the project can say, okay, I see these people have done this on-chain thing, therefore I want them on my token cap table, right? So you can actually approve people after the fact, which deterministically prevents sniping. Similarly, helps prevent Sybil attacks because you can look at very Sybil resistant metrics like their Twitter activity, like their GitHub activity, using Sybil resistant mechanisms. We'll work with you on low float high FDV as any curated sale place would, and again reduced here because of these factors. But there's an aspect of fees that we should talk about in a second. One thing to consider here, there's too many words on this slide, but one thing to consider here is the type of Launchpad you're working with, like who actually has access to that. So in the case of a Launchpad like Binance, where you've got to like stake a bunch of BNB to have access, that could actually mean that only certain types of buyers have meaningful access. There could be other places, at Legion, I personally are not a fan of these models where you have to like hold the Launchpad's token in order to get access. Kind of undermines the benefit of distribution, especially if you're trying to optimize for the best quality buyers. But different Launchpads have different approaches. So that's another thing to keep in mind is like, how much capital does someone need in order to participate, even before considering the capital they're actually using in the sale itself? And that's going to differ wildly based on the platform you go with. So let's get into the fees now. So we've talked a little bit about like the benefits, the relative pros and cons of different approaches, what you get out of it, distribution, right? And the golden period being one of the biggest ones. okay, but what are you actually paying when you work with the Launchpad? Because in theory, you could just do an airdrop yourself. You could host your own sale, right? But there's some downsides to that. Obviously, you're sacrificing on the distribution you get from working with another party, whoever that party is. And so what are you paying when you work with one of these parties? Well, for centralized exchanges, you're generally it's generally bundled with a token listing. I can't think of a case where they would do a sale and not list the token. And so it's generally bundled with the fees for the token listing, which is generally going to look like a cash fee in the ballpark of a couple $100,000 plus a decent, healthy chunk of your token supply. Now, this is more like, upper echelon tier 1 type of exchanges. You'll have a whole host of exchanges that are a bit lower quality that will do maybe, a tenth of this as the token supply fee. But this is generally speaking, if you want to work with the best of the best, the fees that you'd be paying. And so there, on top of that, could be even additional terms that the exchange is layering in, such as additional portion of supply you're giving to like their users, collateral you're locking up. So it could be you're paying, $500K and you're depositing 2 million, or 2 million is being withheld from the amount you've raised, depending on the token price performance, right? If it goes below TG price or sale price, all these sorts of things. So there's a bunch of other stuff that could be bundled in here, paying for marketing. All else equal, it adds up to, a chunk of cash and a chunk of your tokens. And this is going to, if you're working with like a tier 1, tier 2, it's going to be on the lowest possible end, like 0.5%, 1%, up to anywhere like 5% to 10%. Decentralized launchpads are generally going to charge not necessarily an upfront cash fee, but a percentage of capital raised plus a percentage of tokens raised. And they're probably going to be more cash heavy than they are token heavy, because anyone can launch a token. These tend to be lower quality tokens. And so they're looking to get the cash because the tokens are not necessarily going to be very, very valuable. And a lot of these launchpads work on like, whales staking the token of the launchpad to get access, which again shifts who can buy. A curated or underwritten type of marketplace launchpad is going to also have a cash fee and some kind of token allocation. So at Legion, we split this about 50-50. So we're in the ballpark of like 2.5 to 3% cash of what's raised, 2.5 to 3% of tokens that are sold. And that includes, everything includes compliance, et cetera. So we don't have any hidden fees, but different launchpads structure it slightly differently. But generally speaking, this is in the rough ballpark of what you should expect to pay working with these different types of players. I alluded to clawbacks. I want to touch on this briefly. This is something that you will see increasingly in agreements, and so it's very important not just to look at these high, these top level figures whenever you're negotiating with a launchpad, but also kind of the stuff that's hidden in the fine print, because there could be clawbacks. So basically, a clawback saying, look, you raised 5 million in the sale, but whoever you worked with can actually claw back some or all of that if a certain condition is met. And that could be that the token price drops below the sale price within the first 30 days. It could be some more complex calculation. You think about models like MetaDAO, where it's governance controlled. They effectively have this like community governance type of clawback where people can vote and essentially claw back all of the treasury that was raised from the sale. So yeah, this is increasingly a relevant term to think about when you're working with a launchpad of when is the money actually yours? When is it released to you? How much of what you've actually raised is released to you? When and what can go wrong, or what is outside your control that could prevent you from getting all the funds that you on paper have raised? So definitely read the escrow contract, not just the top level numbers here. We've talked about this a bit, so I'm going to move on in the interest of time. Super high level summary, thinking about these different approaches, what percentage of how much you raise, on the surface top level number, you're actually going to receive to your treasury at the end of the day. SEX Launchpad is going to be the lowest, 60-80%. Decentralized Launchpad is going to be the highest, and then curated underwritten Launchpads are going to be somewhere in the middle here. Generally in the ballpark of like 90 to 95. At Legion, yeah, we're right around that 90, 94-ish% number. And then, of course, an airdrop, you don't have to pay anything, but you're missing out on all the distribution that working with another established player brings. So continuing, apparently beating up on Binance. Don't mean to do that. They're still, don't get me wrong, the #1 place to get listed, but that effect is diminishing. And that's something that's very, very relevant to keep in mind, because a Launchpad token sale is very tied to your TGE. The pop here that a lot of teams are relying on for justifying their token sale price and relying on that to hold up their price is diminishing, right? So it used to be that like getting listed on Binance or any major exchange would boost your token price, 40%, 50% plus. Well, most of the listings, again, as we've talked about, have traded down. And you don't really see this giant pop from listing on Binance. There's only one real exchange remaining where you see a meaningful pop getting listed there, and that is Upbit. So what actually moves the needle for TG? It's still important to get day one listings with multiple exchanges, Binance, Coinbase, Kraken, but do not expect that that's necessary. That's table stakes for a great TGE, but that's not alone going to prop up your FDV and like justify some like massively unjustified valuation. This is table stakes. You want day one listing followed by a quick follow on, because Upbit doesn't really do day one listings. A quick follow by Upbit for Korean liquidity. This is what gives you a boost. It could be anywhere from like 50% to 100%, even more sometimes for most projects. Gives you what used to be the same effect that a Binance listing would give you a cycle or two ago. And so getting Upbit, getting Korea is very important to your overall TGE process. And so even if Korea is not participating in the sale itself, which regulations there can be strict, it's important to go after the Korean market and make yourself known there. Market maker relationships are crucial to your TGE. Again, totally different topic beyond the scope of this conversation, but it's relevant in defending that token sale price. A retainer model is generally preferred over a loan call option model. Can't really go into all the details here. I'm sure you have some market makers that are chatting with the accelerator later. But just keep in mind when you're chatting with market makers, like they're in the business, largely speaking, of shorting tokens. That is how they make most of their profits. And so make sure, anything they say to you, you're keeping that in mind. The lower strike price is not always necessarily better, paradoxically. And so one of the things we try to make teams do or suggest to teams is, even if you eventually switch to a loan call option model for kind of long-term liquidity, for your TGE, for the first couple months of trading, try to lock in a retainer model. Generally helps you support that price a bit better or a bit easier. OTC trading, being able to work with your largest holders that you're going to bet are taking chips off the table once you TGE, working with them, helping them minimize that market impact, helping them find willing buyers, helping them find institutional buyers off market. That's actually a key activity for the founder to play after your sale and after TG is helping basically recycle that cost basis. And so you'll have big buyers that have a low cost basis that are cycling out to new buyers that'll have a higher cost basis. Facilitating that process, making it smooth as possible is one of the biggest things you can do to support your TGE price or your price in the market. And similar to that, really leaning into your narrative about revenue accrual, why people should hold the token now that they've bought it, lining up not just retail buyers, but institutional buyers, liquid fund buyers, going on road shows with them, right? These are all things that are really, really crucial to, okay, you've done the sale, you've done the Launchpad launch, you've done the TGE, like supporting all the price, the benefits that you've worked so hard to unlock, making sure that things just don't go to crap, right? To undoing all your hard work and all the money you raised getting clawed back, all those sorts of things you want to avoid. So I touched on this briefly. Yeah, I don't think we can get into the details of this right now, but market maker deals are kind of one of the big silent killers. One of the things that can cause all those clawback terms to kick in and then undo all the benefits that you work so hard for in your Launchpad sale. And then part 3, let's look a bit more at distribution, a bit more explicitly here at the alternative, right? The alternative being the major alternative to Launchpad sales being an airdrop. Massive airdrops used to be the big game a cycle ago or so. It used to be the way you would get massive attention, long tail retail attention. When there were a lot fewer projects in the market, that worked. I think what we've learned from this latest cycle is that even these like tier 1 massively funded projects that everyone in crypto has heard about, even for them, big airdrops did not work, right? Largely speaking, these are all down massively. Hype being, the one exception everyone loves to talk about. But as we'll see in a second, I don't think the airdrop is the big takeaway from that. But yeah, I think if you look at the data, obviously I'm a bit biased, but the data is part of why I am working on Legion. If you look at the data, there's much more signal these days to people putting money where their mouth is, subscribing to a sale, than just showing up and receiving something for free and then dumping it a second later. I think the massive airdrop launch strategy for almost every project is no longer viable. Of course, Monad, right, is the latest one that did an airdrop pretty well, and it's held up, fairly well. They also did an ICO, by the way, and their airdrop, burned all their retail community, or burned a lot of their like farmer community, right? Like it was very distinct type of airdrop approach from what these other players did. So I think you have to look carefully at the details of the Monad situation and the hype situation, because the lessons to learn from there are not necessarily, oh, an airdrop still works. They're quite different. For most projects, airdrops are not working here. The hyperliquid listen isn't do an airdrop, right? I think it's mainly have a product people love to use, have revenue, have value accrual to the token from that revenue, and that is what meaningfully drives the difference. Yes, doing an airdrop helped. Not having VC helped primarily because there's now no additional inflation from VCs unlocking. But I don't think hyperliquid would be where it is today. It would be much more like these numbers if it first and foremost didn't have a bunch of users, a bunch of revenue. So why have ICOs made a return on, compared to airdrops as they've dropped out? Well, regulatory clarity. The Clarity Act itself hasn't fully passed, but we're finally getting some clarity from the SEC guidance, from the Genius Act, which is mostly due to stable coins, but still, signals clarity in the country, in the US at least. MiCA in Europe, which was, I think, came into full effect. And now it's been over a year that it's been in full effect. For the first time ever established, these are the formal rules for doing a token sale to retail investors in a major jurisdiction. And so all that clarity has made it, for the first time, viable for these big projects to do a sale to retail investors without taking on massive regulatory risk. So that's been a big piece. Airdrop fatigue, right? People sick and tired of just getting meaningless tokens, just dumping them and moving on to the next thing, realizing that there's no signal and free farming. That has contributed a big piece to it as an alternative. ICOs being a higher signal alternative. Token sale infrastructure maturing, right? Merit-based kind of allocation. These sorts of like, you can almost think of it as the next step in like airdrop, farmer filtering evolution to get even higher signal tokens into the hands of right people. And then IPOs, have contributed some to that as well. These like high profile sales effectively, or distributions of equity to retail investors have made it a bit more palatable to do sales. And then, I think that underlines the Monad sale, for instance. That was a sale where, even though, yes, formally clarity has not passed, given kind of just the overall backdrop in the US from crypto's adoption going more mainstream, from the regulators there working on regulation, positioning that sale as a commodity, the token as a commodity, therefore not the sale of a financial security. And I don't know, the The SEC is going to change hands at some point. The Democrats might get in the next election, but so far it's worked out for them. That regulatory posture, it's definitely a risk-on posture because of all these elements for ICOs and for doing sales, for even including non-accredited U.S. persons, which I don't think many people realized that the sale did that. But yeah, there's been a couple sales now that have included non-accredited U.S. persons, which just a couple of years ago would have been unthinkable. I want to take a couple minutes here. I know we're running out of time. A couple minutes here, though, to wind out on the topic of commodity, basically tokens versus equity, and that classification of your token as a commodity as being so important to your regulatory approach. And then we'll have some time for some Q&A. But while this is not yet literal regulation, there have been repeat signs, repeat guidance from the SEC, repeat comments by Chairman Atkins, and just the lack of enforcement activity by the SEC against teams that have taken this positioning to view their tokens as digital commodities. Now, to be clear, that does not apply to every type of token. You as a founder increasingly need to think about an honest conversation with yourself, with your investors, with your community members. What am I really doing here? What am I really building here and launching? Is my token a kind of parallel thing entirely, or orthogonal thing entirely, I should say, to my equity? And this would be the case of like digital commodities, right? Like native L1, L2s, autonomous DeFi tokens, where all the activity, all the revenue, all the control, everything is living on chain. And like in some cases, like Bitcoin, for instance, you couldn't even have equity if you wanted to. It doesn't make any sense. It's not applicable. For Uni, it's kind of controversial, but right, they have the equity for the front end kind of fees, and then they have the token for the protocol kind of fees. So you have to really think about carefully when you're launching your token. Is it a digital commodity? Is it governance? A more typical governance token. If so, how does it accrue value? Because increasingly the marketplace is tired of meaningless, valueless governance tokens. Or is it equity-like, right? Is it basically masquerading as, am I basically just like the real value of my company is going to my equity, and I have this token that is masquerading as equity, but isn't actually accruing any value? Or are you tying it more closely so that it is truly, equity-like, or in the extreme case, tokenized equity? To be honest with you, this is still an evolving field. It's mainly a regulatory constraint, as well as a kind of mechanism and token design constraint. But I think from an increasing number of teams, tokenized equity will be the right strategy, the right approach. And so that applies to your Launchpad sale, that applies to your TGE, that applies to your token overall. But it has really meaningful implications about all the fundraising you're doing, especially a Launchpad sale, especially fundraising to retail investors and to your TGE. And so I think the reason these are kind of in white and these are kind of grayed out is I think the viable strategy for most projects is either going to look like you're taking a hardline stance that your token is a digital commodity. It's completely orthogonal to any equity you might have in your business. It has value accrual, right, via some kind of mechanism. And that's the line. And then you can go and sell it to, virtually anyone. Again, you should speak to your lawyer about that. That's not hard, true regulatory rules right now, but it is how the direction the market is headed. Or you take the totally opposite approach. You say, it's not a digital commodity, it is equity, or it is equity-like, and here's the way the token relates to our equity or replaces our equity. I think that is increasingly important for you to answer that before you do any kind of retail fundraising, let alone your token launch. Tokenized equity is eating utility, right? You've got $25 billion in like tokenized equities on chain now. You've got a bunch of different approved parties that are issuing tokenized equity. Even NASDAQ, right, is getting into this stuff. So these are all loose trends that kind of justify why I believe things are going that way. Here's a neat decision framework you can use to look at and think about, like, how should we launch our token? How should we structure it? What should we do for our TGE? I'll skip that in the interest of time. So yeah, maybe 5 things just to summarize here to close things out on. You really want to approach your Launchpad decision thinking about a capital allocation decision, right? You are allocating your limited resources in terms of your token supply, in terms of your treasury, to unlock some kind of benefit. What benefit are you looking for? Are you looking for distribution to certain types of users? Are you looking for maximum, spread distribution? Are you just looking to distribute tokens to your existing audience? That goal that you have and the resources you have available to you is going to inform the exact best approach for you. You want to price for your buyers, not for your investors, right? So retail sets the margin price post TGE, and they are very unforgiving about unlock schedules, vesting, very sensitive to vesting schedules. You want to pay very close attention to the fine print in any agreement you're signing, any escrow contract. Don't just read the high-level stuff. Look into the details of the refund policies, the clawback mechanisms, right? Think very closely about the terms you're entering into, if the launch is bundled with market makers or bundled with an exchange listing. The tokenization wave is definitely real, and I think the market overall is bifurcating, as we've just talked about, into these like pure native on-chain assets, digital commodities, if you want to call them that, and the alternative being equity or tokenized equity, and very, very little that will succeed, at least in the middle ground. And so I think you want to be increasingly clear, crystal clear about which camp you fall into, and that will inform all of your strategy here. And of course, the best TGE is the one that you don't have to apologize for in 12 months. Even if you're launching at a lower FDV, it's painful in the moment. You have to be honest with yourself and think about how can we launch and have upward price momentum afterwards, continue the momentum again, unless the only thing you care about is just dumping tokens and then signing off and never being seen again. You're going to have the best chances of long-term success by launching at a much more reasonable FDV, regardless of what you've raised at in the past, thinking very critically about supply unlocks and working with the right partners on all this stuff, on Launchpad, on exchange, and market maker. I mean, those are all super key decisions to a successful TGE. So I'm sorry I've gone a little bit over what I wanted to do in terms of talking. Here's my socials and contact if you want to reach out, any questions, but we do have a couple more minutes here, so I'm more than happy to take a few questions.
Thank you very much for the very insightful lecture, Maddie. Much appreciated. And we made some notes, but just to get the fire going, as we usually do, I have one main question I wanted to ask. You mentioned that on day one listing, a great thing is, you have Binance, Coinbase, or Kraken. Then you go second day, to Upbit. For a lot of projects, they aspire to this and even burn millions of dollars on promises, like Binance Alpha. But would you say, or rather, how would you differentiate between a project for whom it's better to just launch on a decentralized exchange, super low valuation, like $1 million, $2 million, whatever, but like real calculatable, because you only have like 1,000, 2,000 users, whatever, and then you grow that as you grow your business, and then you reach out to Binance and Coinbase, and by that time you already have the volume, the users, and the token price chart that's only going up. Like, for which projects would you say it's better to aim to Binance and Coinbase from day one? I don't know, obviously it's for the bigger projects, but is there like a specific line that you would draw?
It's hard to draw a specific line because it changes with the market cycles, but the most specific line would just be like relative line to like what projects are getting listed on Binance, right? But these fees that exchanges charge, the projects they charge, it changes as they change their internal policies, as the market cycle changes. But just at any given point in the market, you can go and look at, okay, in the last month, who was listed. You can get in touch with those founders. You can ask them about the process. You can ask them how much they paid to get that listing, right? And you just have to be honest with yourself, right? Like the projects getting listed all raised from Paradigm and A16Z, and they had like hundreds of $1 million in VC capital, and you are not in that league. Do not pretend you're in that league. You'll get a much worse outcome if you try to do that.
Yeah. Okay, perfect. I know Dan had a question. I can ask it if you want, or if you're not here.
No, it's okay. So, Matty, I saw a post you actually posted on Twitter a while ago, and it was about the convergence or the return of rather sort of retail funding versus VC funding. Do you think that's a trend that will continue? And do you think more founders should look to fund from retail and their communities versus like looking at VCs as the holy grail? Or do you still think that VC funding is something that will like drive the industry forward?
I mean, I think VC funding still will play a critical role. but it's going to be more concentrated than it was in the last cycle. In the last cycle, like VC funding was relatively easy to come by. And I think it will get more and more difficult. You'll get fewer and fewer players writing bigger and bigger checks. And so you just have to think about like, what type of project am I? Where am I coming from? How do I position? If you are one of the projects that can raise that big VC check, great. If you're not, you need to think a bit more strategically. Retail fundraising, retail capital remains very viable, but two things: people are sick and tired of buying useless tokens. So you need to think about, how can we make the token more valuable, more hard, value to it, value accrual, equity-like. Maybe you're literally going and leaning into tokenized equity, which is a developing field. No one has all the answers for it yet, but hopefully we'll have some answers for people soon. And you have to think about valuation, of course, but you also, when you're speaking about retail, you have to acknowledge that like even retail investors, as much as they say they hate VCs, they get comfort seeing a big VC having invested in the project. And so you need to think about how you have momentum, how you have that signal to retail investors that you are a trustworthy project, you are a project that's going to make them capital, that they need to feel like they're getting alpha, they're getting in, it's a good deal. So that's the challenge with purely raising from retail, is like you don't have the social signal that you do raising from VC.
No, that makes a lot of sense. Yeah.
And is there anyone else? I saw Neil mute. Jordan, you turn your camera on. Yes, please go ahead.
Yeah. So Matt, first, thank you for that. That was really interesting. I just want to get your take on something, because it's a structure that we've been thinking pretty hard about. We're building Moonwhale, which is an on-chain loyalty and payments protocol. But the unusual thing about us is that we're not like a typical token play. We're built on top of Cafe Whale, which is Korea's largest autonomous cafe network with 700 live robotic locations, 100,000 daily customers, 80 million in verified transaction volume. And we're backed by Samsung, LG, Hyundai, GS, a lot of Korean heavyweights. So unlike most projects that come to Launchpads, we have a real operating business underneath the token. And because of that, we structured our raise as equity in the operating company plus an equal percentage token warrant in Moonwhale, so that investors can get exposure to the hardware revenue that's already real and get some upside in the network layers simultaneously. So you can kind of think of it like the equity is the floor and the token's the call option, and the floor is already profitable. So my question is, does that dual structure create any complications on your end in terms of how you'd approach the launch? And is that something you've worked with before?
I mean, yes to both, really. Like it always creates complications because this is still a developing, field and topic of like, where should the token live? What should it do? Where should the equity live? I think that you have to be careful about this increasingly, because this schism is really happening. Of like, people are getting sick and tired of like all the value going to the equity, and then like the token basically doing nothing. And the solution to that is a token that is either this very clear standalone digital commodity thing that like governs some revenue and earns some revenue on chain, or the token is just a different form of the equity. And so, it's a little bit of a developing topic, but you don't want to get into this world where effectively you have a fiduciary duty to your equity holders. Like you got to effectively, your Web 2.5 business, and you've got to route like revenue and everything to the equity, and the token is just as like stapled on afterthought. It's not going to perform well, right? So I think you have to just be careful about those elements. Think about it very clearly, communicate that clearly. Maybe that means launching a token isn't right. Maybe that means launching a token that's tokenized equity is right. Maybe that means redesigning the business so there's a more pure on-chain element is right. It differs a bit case by case, but I would try to avoid as best you can, like just hoping for the best, winging it, and like launching this token that's like, well, it'll have value because it's loosely affiliated with this company that has value. Like that used to work, doesn't work anymore.
Perfect. Then yeah, I think on that note, Maddie, I pinged the notes in the chat, and if anyone wants any introductions or wants to chat, obviously we'll help out, we'll connect. And other than that, thank you very much for the lecture as per usual. It's been very insightful. The video will be up and I'll send it to you shortly. And then if you're happy for it to go public, then we'll send it off after the accelerator ends. But yeah, thank you so much, and have a great rest of your day.
All right, cool. Thank you guys. Thanks, Alex.
And for everyone else, we have a lecture on personal branding in an hour, or just a bit less than an hour. So if you're selling B2B, if you want to grow your personal brand on LinkedIn, etc., highly recommend it. To be honest, I recommend it to everyone other than people who are like in the Solana trenches, to be honest. Super valuable. So yeah, thanks guys.